Hello everyone, today's vlog is all about personal pension contributions. Not to be confused with corporate pension contributions, of which I've done a separate vlog on that. Personal pension contributions work in a very different way to pension contributions from your limited company. So with a personal pension contribution, why would you want to do a personal pension contribution? Okay, so one of the main reasons you'd want to do a personal pension contribution is to reduce your income tax bill. So looking at income tax planning. So specifically, if your earnings exceed £100,000, your personal allowance is restricted. So if you earn more than 100 grand, the personal allowance is clawed back £1 for every £2 of earnings that you have in excess of 100,000. So basically, if you earn more than 125,000 pounds, you have no personal allowance. So remember, the personal allowance is the tax-free slice, 12.5 grand that every man, woman, and child has before they start to pay tax on the income. So if you earn more than 100,000, that is clawed back until you get to 125,000 and it's gone completely. So what that means from a tax point of view is that every pound that you earn between 100 and 125 grand is actually taxed at 60%. The marginal tax rate is 60%. It's not 40%, it's 60% because of the effect of the clawback of that personal allowance. So what can you do about it? Well, there's a couple of things, but there's one real main thing that you can do, and that is to pay into a pension personally. So let's just have a look at the rules. So when HMRC talk about this 100 grand threshold and then clawing back personal allowance when you exceed it, what they're actually talking about is adjusted net income in excess of 100,000. So adjusted net income is broadly your taxable income less a couple of deductions, and the deductions are gift aid contributions and personal pension contributions. Now, not many people are that philanthropic that they'd like to make a 25 grand charity contribution, but they could certainly do, and probably would want to do, a 25 grand personal pension contribution. So different factors come into play that you need to think about. Other rules say that pension contributions are limited to annual allowance, which is £40,000, which is the sum of all contributions into your pension fund from both personal and corporate. So if you've already made a contribution into your pension pot from your business, from your limited company, straight away you need to see how much capacity you've got left of your £40,000 to then make a further contribution from you as an individual. Yes, you may have capacity from previous years and all that sort of thing, but bear in mind the limiting factor of what is the maximum you can do. So the other thing is, in terms of the tax relief for pensions, personal pensions, it's all about what they call relevant earnings. So you have to have enough earnings to frank the pension contribution. Now, earnings are broadly salary and business profits, if you're a partner in a partnership, say, or a sole trader. Relevant earnings do not include dividends or rental income. So if you have this issue that you're paying 60% tax, let's say you are earning 125 grand a year, but most of it is dividends, then you may not have enough earnings to frank the 25 grand pension contribution that you'd like to do. So bear in mind, what is the makeup of your income stream? It could be that if you are a highly paid employee and it's all salary, then yes, absolutely, that would qualify for you to do this. So have a look at what is your makeup of your income stream. Does it qualify, firstly, to pay such a large pension contribution? Assuming that it does, what are the tax impacts? So coming back to the example, you earn £125,000 a year. 25 grand of that will be taxed at 60%. If you make a gross pension contribution of 25,000, HMRC will deem your adjusted net income to be 100,000. So 125 less the 25 pension is 100,000, and lo and behold, you get your personal allowance reinstated. So you're not suffering the 60% tax anymore because you've made this pension contribution. Now, in terms of how much cash outlay you need to make, with personal pensions, we have this thing called net and gross pensions. So the gross pension is 25,000. However, you don't have to write a check for 25,000 pounds to your pension provider. You only have to write a check for 20,000. 25 grand is the gross amount. The net amount is 20,000, and that's calculated by dividing the gross amount by 100 and then multiplying by 80. So 4/5 of the gross amount is the net amount, 20 grand. So you write a check to your pension fund for £20,000. HMRC then top up the balance. They will write a check for £5,000 to the pension fund. So £25,000 lands in your pension pot, 20 grand from you, 5 grand from HMRC. That is a gross contribution of 25,000. That then reduces your adjusted net income down to 100,000, and you get your personal allowance reinstated. Now, as a higher rate taxpayer, you can also claim additional tax relief on that pension contribution, and that is achieved by your basic rate band being extended. So the point at which 40% tax kicks in is extended for that gross contribution. So in this example, the gross contribution is 25,000. The basic rate, high rate threshold is currently 50,000. So normally you'd start paying 40% tax on any income you receive above 50,000. But if you do this pension contribution, the 20% lasts longer and 40% kicks in later. So in this instance, you don't start paying 40% tax until earnings of £75,000, not 50, £75,000, because you've got this pension contribution. So it's a double benefit for doing this. Not only will you have your personal allowance reinstated and you will save paying tax at that ridiculous marginal rate of 60%, but you will also delay the point at which you're paying higher rate tax, and you've got money into a pension as well. So for a cash outlay of £20,000, you have saved an enormous amount of tax. So yes, that money is going into somewhere else other than your hands, but it's going into your pension pot, which is a good thing. It's not going to the tax man. So you're saving 60% tax on that pension contribution. So not only is pension tax planning, individual pension tax planning, a good way to have your personal allowance reinstated, but there are other couple of areas where it comes in handy as well. One of them for child benefit. Now remember, child benefit kicks in where one of the parents in the couple earns more than £50,000 a year. So again, it's an income threshold test. But if you make pension contributions, that threshold is adjusted and you knock off the pension contributions in exactly the same way, more or less, as the personal allowances we've just gone through. So if you think that you might be clobbered for the child benefit tax charge because you earn too much, but you maybe have a few quid to spare to put into a pension, well, make the pension contribution, bring your threshold down, and HMRC won't come after you for the child benefit tax charge. So better off in your hands, albeit in your pension, than in HMRC's hands. Another example of how pension contribution can benefit this way is with regards to chargeable gains on investment bonds. So chargeable gains on investment bonds, again, similar principle. They are taxed depending on your income threshold, whether or not you're a basic rate taxpayer or a higher rate taxpayer. So if you can bring down your income thresholds, the tax that you pay on those chargeable gains on the investment bonds when you cash them in could be lower. And again, pension contributions can achieve that aim to get the threshold down. Similarly, with capital gains, if you have a capital gain and you will pay capital gains tax on that, but capital gains tax, the rate at which you pay it is determined on your income level, your taxable income. So you're paying capital gains tax based on an income tax threshold. Now, again, paying a pension contribution can get you below the certain threshold. So let's take an example. Let's say you have a £50,000 salary. So you are still just in the basic rate band. Any more and you'll trip into higher rate tax. But you've got a capital gain. You've got a capital gain of £10,000. Now, £10,000 for capital gains tax will be charged at 20%, assuming it's not residential property. There's separate rules for that, but it'd be taxed at 20% if you're a higher rate taxpayer, or 10% if you're a basic rate taxpayer. So the fact that you are right on the cusp, the gain will trip you in to a higher rate threshold. So if you're on 50 grand already, you have no more room left in your basic rate band. You'll pay 20% capital gains tax on that gain. However, if you made a pension contribution, a gross contribution of 10,000 to get you back to 50,000, which equates to £8,000 net, then you are only taxed at the basic rate for capital gains tax, which is 10%. So you're halving your capital gains tax bill, going from 20% to 10%, simply by paying a modest amount into your personal pension. So pensions, good for income tax planning. If you have issues such as you're earning over £100,000, you have child benefit tax charge issues, or you've got chargeable gains on investment bonds, or indeed capital gains on other assets. Think about personal pension contributions as a tool for mitigating the taxes thereon. But do bear in mind the interaction between corporate pension contributions in terms of how much capacity you've got left in the year to make individual contributions, and also the makeup of your earnings. Do you earn enough from non-dividend income to be able to do some of these contributions? And also the annual allowance. So there's lots of things to factor in when doing pension contributions, but if done right, they can save you a considerable amount of tax. If you like this video, please do subscribe, and I will see you soon.